Hey traders, Raghee here, and in this recap video we're going to go over some of the more old-fashioned commodities that we cover over at Simpler Futures. Now I know we've been talking a lot about a handful of currencies like the euro, and we've been talking about crude and NASDAQ and gold and a lot of those kinds of futures contracts and forex markets because they are very much intertwined. But one of the things that we do as well is just trade good old-fashioned commodities, and we're going to talk about some of those right here. In fact, some of these are in trade management mode. So let's talk about daily beans. Now daily beans had been making me kind of nervous. And what I'll typically do, as long as the trade is still valid, is I might just reduce my position size. Now, granted, this time my nervousness was not, it didn't pan out, but I'm still glad that I think about position size in situations where we're not punching down to lower lows when I want there to be a downtrend reorganizing. We really didn't see that downtrend reorganize as much. So we had shorted, actually we've shorted this soybean market along 944, a grand total at this point of 3 times. This time was my smallest position of the 3 because we were moving lower and then we snapped back up, and then these 3 candles made me insanely unhappy. So when I see that kind of movement, I want to be aware that we could see possibly that one candle that just busts up through 952. So instead of saying, well, I'm not going to take the trade, I'll just be much more hesitant about it. And I'll say, look, it's an aggressive trade. I don't like the price action this is leading into, but it's still a valid trade. So we'll just go with smaller position size, and I can sleep at night. Okay, beans continues to plot red grab candle, so there's no reason for me to get bullish here. It's just that I'm not as certain a bear as I was when we were shorting 944 and it was holding. But lo and behold, am I glad I took the trade? You bet. Why? A couple things happened all in a very similar area. Let me clean up some lines and levels here, and I can show you some of the tools that we use in the chat room and in the premium videos, and tools that you can actually put to work really easily. Okay, I've got 2 amazing and free tools running on this chart right now. One is my 34 EMA wave and the grab candles, and the other is a 70-year-old tool called the Darvis box. You actually don't even need an indicator to calculate it. You can actually just do it by hand, and after a while you'll just be able to do it by sight. But this automates it. These are the, what is this, magenta and yellow lines that you see on my chart, horizontal lines. I'm a fan of horizontal lines, not trend lines. And I know that sounds almost blasphemous, but what you'll get with dynamic horizontal lines is something better and less subjective than trend lines. So what happens here? I've got 2 great things happening all at once. Previous resistance, yes. A Darvis, of course, because Darvis is based, it plots on previous resistance and support. And then I've got the 34 EMA heading lower. I've got the 34 EMA on the close, which is a slightly more conservative level within the context of this dynamic resistance area that keeps prices heading lower. And when I've got Darvis and one of my wave lines kind of connecting, overlapping, stacking, that's the terminology that I like to use, that's a pretty powerful level. So I had previous highs, the 34 EMA, my Darvis, which is based on those previous highs, and boom, there's your short. We had a couple different profit targets to the downside. We had an optional 931, a non-negotiable 926, and the next level that I'm waiting for is down here. And we keep this in the spreadsheet in the members area. We've had this soybean trade going on and off since the 7th of the month, and we are looking at 913 as the next target to the downside. So this has been a great trade, and that's what I'm looking for next. Here's the important part. I would like everybody to put their stop at a break even, because if we snap back up, I don't want you to give back anything more than unrealized profit. If you want to be a little bit more conservative and you have a slightly higher risk tolerance, go ahead and put it at 948. The validity for this whole trade extends to basically 951 now, 951, 952. If we break that level, if we get above 950, I'm really not interested in the swing shorts anymore. I'll have to re-identify where exhaustion could kick in and maybe start shorting 952, 953. Let's hope that doesn't happen, not at least until we hit 913. Okay, so what else do we have? Coffee. We've actually had coffee. Like I said, good old-fashioned commodities. For those of you saying, okay, Rog, do you trade things other than currencies and NASDAQ and crude and gold? I know those are fan favorites, but yeah, there's a lot of other great markets that we trade. And coffee's been another one of them, again, on our spreadsheet. And this one was a trade that we put on the 7th, swing short. It was the second time around that we had taken this. And this was a 130.35 entry. 930. Yeah, I'd love to be short from 9. So it's a 130.35 entry. And we've hit the first profit target at 9. I keep saying 9. 128.05, 127.05, and then 125.55. Here we are at 122. Gang, we're coming up on a very nice 8+ point win on coffee. That is not too shabby. Following the trend, second time we've done this. Okay, so what am I looking for now? Well, eventually we're going to wait and capitalize on another bounce into the wave. That's the plan here. We will capitalize on another bounce into the wave and get short again. All right, so trend following here. Now, what do you do with a market that's gone beyond your first and second profit targets? You start to trail. My first two profit targets are proactive. I call them finish line profit targets. I want to realize a profit as we cross through them. When I transition to a trailing stop, this transition happens usually after the second profit target, and I will call that a safety net, meaning I am looking at a stop that I'm going to back off. I don't want to smother price action. I'm going to back off and basically protect a certain amount of unrealized profit, but when that trailing stop gets hit, it will lock in a certain amount of unrealized profit. I'm not willing to take it to a break even any longer. One really easy level to use would be the whole theory of what was once support becomes resistance. Okay, so that would be a really easy level to use just above the 127.20 minor psych level. That'd be an easy trailing stop, because if you have a 130.35 short and a 127's call it 35 trailing, you've just locked in 3 points. Show me your stop loss and I'll show you your P&L. This would be locking in 3 points. Not too shabby. So think about how you transition from your initial stop loss, which is usually risk-based, to a break-even, to a trailing, and that's the mode that we're in right now. And here are two symbols that are on our watch list, trades that we've had, and how we're managing them at this point. Now, a lot of people put emphasis on entries, but I'll tell you what, I meet a lot of traders who are great at entries, and they stink at trade management, at profit management. They stink at it. It's not what you make. Or actually, it's not, well, actually it is not, it's not what you make, it's what you keep. If it's unrealized, it's not real. It's until you have a trading plan to capture, to lock in those profits, do you have a complete trading plan. And I see a lot of traders interested in the next entry, but they're not managing their current open winners. And that's a tragedy. So I hope I've addressed that, how we do it in the room, and two kind of good old-fashioned commodity symbols that we've had on our watch list, along with things like the NASDAQ and the Nikkei and crude and gold, etc. All right, I'll see you in the next update.